Good morning, everyone, from CTP here in Prague, Czech Republic. Excited and thanks for dialing in. It's good to have you on the call. We are going to talk about the 2025 results, which are good. But before we start, I also like to look back at 2025. You could say has been 25 years of growth. We have completed our first building in 2000 here in the Czech Republic in Humpolec, where we did our first CT Park model. The CT Park Humpolec was the first site we acquired, initially 10 hectares, and later on we had the opportunity to grow that park. So that's where we first started with a clubhouse where we looked for people and did establish a small team and did then develop a number of properties, and those buildings are still fully leased. And many of the tenants which we initially had, actually, they're still there and they've been able to grow their business. So 25 years of continuous growth, which started with nothing, with a piece of land and then one building and second, et cetera, et cetera. So thank you very much to all the very loyal clients, all those companies who we have been working with, the companies who gave us the opportunity to work for them outside of the Czech Republic later on. And of course, thank you very much to all people we've been working with a lot over the past 25 years. And thank you to all other partners. And of course, the fantastic team here at CTP, which in the meantime is 1,000 people, more than 1,000 actually nowadays. So that has been 25 years of continuous growth, good times, bad times, with all kind of different opportunities along the way. For 25 has been a strong year, has been a good year with good results, which illustrates also the growth engine, the thing we like to do. We like to grow, and the largest growth engine in the business here in Europe. So last year has been also an important year for us because we added another country. We opened up business in Italy. In the meantime, we have more than 200,000 square meters of projects under construction in Italy, mostly pre-leased, 70%. We do that in south of Milan, close to Piacenza, Castel San Giovanni, but also in Padova. And we have other projects on the way. At the same time, we set up a team of people in Italy, and we have a land bank to build an average of, we think, 200,000 square meters of properties over the next years. And we hope within 5 years to hit the 1 million square meter lettable area target in Italy as well. We see good opportunities in Italy. Overall, we see opportunity in Europe over the next year. So we're quite happy with the entry so far, and we're making good progress. The land bank, mostly North Italy, but also strategic sites in the region of Rome. So there's also other places where we believe we will be successful in the development of our industrial properties. Again, mostly for existing clients, so the companies who are already renting from us in other markets. For those clients, we plan to develop properties in Italy, and the amount of business we do for existing clients is approximately 70% of the total amount of business we do. When we look at drivers, for Europe, it's definitely nearshoring. Asian companies come here, set up shop in Europe for Europe. I mentioned defense, but also technology, semiconductor industry, consumer goods. People have more free time, so they go out biking, running, pets, massive industry. We do multiple facilities for pet food producers, pharmaceuticals. So there's a whole, of consumer spending means people have more money to spend than they had 25 years ago when we started here. And we see that in other markets, in Serbia, in Slovakia, in Romania, where we came initially maybe for low-cost manufacturing and later turned into manufacturing for domestic market. And nowadays, Central Europe is the engine of Europe. Here is where you go for manufacturing. And that's all positive. So relatively good outlook, and we have a number of growth drivers. We are not in it for the short, we're in it for long. So we have plans for the next 25 years. And those plans are definitely to make CTP a global player and to grow with our clients and to use all the experience we have building business parks. Last year, we signed 2.3 million square meters of new leases, 2.3, which is a bit more than we did the year before. In 24, we did some 10% less. Rental rates were a bit higher last year in 25 compared to 24, approximately almost 5% higher rent than same building in a year earlier in 2024. So a bit rental growth, 10% more deals, and still at around 10% yield on cost. Target, midterm ambition, continue to grow with existing clients, which we have a lot of them. Good companies, they pay on time. They 99.7% is debt collection, so money which we charge to tenants, which is paid. And as I said, most of them on time, good companies. 70% of all new business we do with existing clients have 80% retention rate. And which is also important to mention, 75% of all the projects we do are being built within existing business parks. So we don't do standalone boxes. We really create an address, a park, an environment, an ecosystem with sufficient infrastructure, amenities, facilities for people to work, develop themselves, to create business together, to work together, to grow stronger, and to have a stable business park. Also not overexposed to one specific industry. You want to mix it up with different industries. It's also good for labor market. We see a lot of automatization among our tenants. So they continue to invest in their facilities, in their production lines, in their technologies, which is good as well. We break it down at CTP, as you know. We talk about three things. We have the operator, which is the income producing part. So the part of the company who look after the buildings which we have built over the past 25 years. It's 840 million euro of rental income, on the way to hit a 1 billion euro rental income next year. So that's the operator with good occupancy level, always above 90%, between 93, 95, depends a little bit on the market and the location where you are. Depends also on how much property we actually build to enter a market, and you need time for the market to absorb all those buildings, but we remain at the target around the 93, 95%. So that's the operator. Then we have the developer. Those are the people at CTP who develop properties, or who build business parks and properties. Quite active now also with inventing new type of properties, adjustments, constantly working on making these buildings better, both the existing refurbishment, upgrades, but also new properties. And better means flexibility. So we have genetic designed buildings for multiple generation, energy consumption, maintenance. Those things are important when you design a property. So that's where these guys are busy with. Some highlights as well, what we've done in terms of completions last year. 1.3 million square meter, 180,000 square meter in Bucharest, 65,000 square meter in the CT Park Budapest in Hungary, but also, of course, in Brno, Czech Republic, the home of CTP, where we have built millions of square meters. Last year, we did a deal with FedEx, for example, just to mention one. Part of our 30-30 plan, right, to grow to 30 million square meter. 2 million square meter under construction this year, which is good for 150 million euro of rental income. I'll highlight, maybe if you talk about those 2 million, we do a lot in Poland, the largest economy, largest country in Central Europe. Very dynamic, can do, a lot of support from the government. Very, very good locations, I think, which we have secured. Good team on the ground. So there we invest a significant amount of money now building properties, mostly leased in and around Warsaw, but also Upper Silesia, Katowice, Zabrze, as well as along the German border on the west side of Poland. So we see there good opportunity, as well as in Gdansk, by the way. Another highlight I would, Bucharest, Romania has been good, is still strong. Serbia strong. Germany this year is important to get things going in Mülheim. Some of you have been on the Capital Markets Day event last year. We looked at Mülheim, an energy park with Aeon, Siemens, and more to come. So that's happening, making good progress in Düsseldorf, as well as in Wuppertal. So overall, quite positive about Germany as well. I think, well established and good position. Last but not least, the growth engine, the third activity. We look globally at opportunities in different countries. And how does this work? Well, it comes from clients. Clients tell us, okay, we are going to that market because we see growth, we need properties. Are you there? Sometimes we are, sometimes we are not. And if we are not, then we have a closer look at such a market. We think, shall we go there? Does it make sense? No. And we constantly do that. Sometimes we do not enter. Sometimes we have a closer look. Now, we always have the desire, as you know, to also become active outside of Europe, because we see other opportunities in other markets. And we found good opportunities in Vietnam and strong demand from existing clients. So we continue to have closer look. We announced it last September. And so far, we've been making some good progress with having a closer look at the market and the opportunity. I have a few people in the meantime on board. So we have a CTP Vietnam, and we have there a small team of experienced industrial property people. Vietnam, obviously, strategically located, 100 million people, very productive workforce, but also quite young people around 30 years of age. So in the future, also, you will see consumer spending, well connected to the rest of the world. That would also give an opportunity to get us feet on the ground in Asia and also closer to other Asian companies who look at coming to Europe. And I will keep you up to date on developments we are making. Yes, not only about getting bigger, need to also get a better company. So we are obviously constantly working on getting a better company with maybe doing more buildings with less people, more efficient, more effective, different processes and procedures. We automate, for example, when it comes to property management, when it comes to energy consumption, we know exactly how much energy tenants consume in their buildings. We can help them again with energy management, with clear understanding of the condition of the building, and when there are issues, property management related, then we can fix that. We have a clear system for that in place in the meantime to monitor all the maintenance and repairs which potentially are needed. So both energy consumption as well as maintenance and repairs to make sure buildings are in good condition and remain in good condition. That's one example. And there's many other things we've done whereby we introduce new processes better and software and automate, standardize, digitalize the company. And that makes us think better and quicker and more efficient to continue grow our business. Yeah, so we're looking forward very much to the next 25 years. Thank you for your attention. I will hand over to Rob. Some of you know Rob. He's not really new to CTP, but as an IR, we are happy to have him on board and look forward to answering your questions.
Turning to the financial highlights. Net rental income increased by an impressive 14.1% to 738 million euros, driven by record leasing of 2.1 million square metres, excluding Italy. Like-for-like rental growth came in at 4.5% in FY25, accelerating from the 4% we delivered in FY24, and this was driven by indexation and positive rent reversion capture. We also delivered record development completions of over 1.3 million square metres, with occupancy at the year end still remaining stable at 93%. Annualised rental income increased by 13% to 840 million euros, illustrating the strong cash flow generation of our portfolio and locked-in growth profile of our business for 2026. Company-specific adjusted EPRA earnings increased double-digit by 11.3% year-on-year to 405 million euros. CTP's company-specific adjusted earnings per share amounted to 0.85, an increase of 6.3% year-on-year, as we also made positive progress on our debt refinancing during the period. This EPS figure was just 1 cent variance to guidance, driven by the timing of development completions in Q4 25, with some moving to Q1 26. As we look forward, the important message here is that our medium-term double-digit annualized growth trajectory is unchanged, as Richard will highlight shortly. Now, looking at the valuation results. The revaluation of the portfolio for 2025 came to over 1.1 billion euros, a key contributor to our leading total accounting return for the period. Of this positive portfolio performance, 422 million euros was driven by the construction and leasing progress on our developments, while 649 million euros came from the revaluation of our standing portfolio, with the balance from our land bank. As at the year end, the total portfolio gross asset value now stands at 18.5 billion euros, up 15.6% from FY24. CTP's reversionary yield stood at a conservative 6.9% at full year 25. For 26, we expect further selective yield compression and positive ERV growth in line with inflation. This is also illustrated by the new leases that we signed in 25, where rents were a solid 4% higher than 2024, adjusting for country mix. The supportive demand drivers of our business remain present, whether that be nearshoring, manufacturing in Europe for Europe, businesses upgrading their supply chains, or reacting to the changing global landscape alongside increasing deglobalization of political agendas. Our core CEE markets, where industrial and logistics space per capita is half of that of many of other Western European markets, continues to benefit from these supportive trends, alongside our own Western European markets and our opportunities being assessed outside of Europe. We are not short of opportunity, nor are we short of capital, with that opportunity driven primarily by the embedded value to be unlocked from CTP's existing land bank of more than 33 million square meters, with the majority next to our existing CT parks. This land bank that we have on our balance sheet allows us to facilitate our tenants' growth as a solution provider for their real estate needs. We remain active in the market for the acquisition of land, especially in Poland and Germany, and we replenish and in a number of cases grow the land bank in existing markets where returns are the most attractive. Now, as Ramon mentioned, we also continue to look to enter markets such as Vietnam, following on from our successful CTP Italy market entry at the back end of last year. Our EPRA NTA per share increased from €18.08 at year-end 24 up to €20.39 at FY25, and this represents a strong increase of 12.8% during the period. With this NTA growth, in conjunction with our dividend distributions, we delivered a total accounting return to our shareholders of 16.1% over the past 12 months, highlighting our superior total return profile, which is underappreciated by the equity market within the real estate sector. I now hand over to Richard.
2025 was another year of solid growth for CTP as we continue on our journey to 30 million square meters of GLA, a doubling of the current portfolio. The company's interconnected business units, the operator, the developer, and the growth engine are all supported by our strong access to debt capital markets, diversified funding structure, and multiple sources of liquidity provided from across the globe. 2025 saw us receive an investment-grade credit rating upgrade to BBB flat from Standard & Poor's. Moody's also have a positive outlook on our credit rating, confirming the growth trajectory of our business. This January, we again evidenced the high institutional demand for our debt, issuing a 4.5-year bond at a spread of only 92 basis points, with a peak order book of over €4 billion. Looking forward, we will continue to diversify our sources of debt funding, as well as managing our liquidity to ensure we do not hold material excess cash. We also target growing our share of unsecured debt towards 80% of total outstanding debt. Turning to the key credit metrics, our interest coverage ratio was unchanged quarter on quarter at 2.5 times, and we expect this level to be the bottom. Our normalized net debt to EBITDA remained broadly stable at 9.3 times, and our loan to value stood at 46.1%. This LTV is marginally higher than our 40 to 45% target due to us seizing the acquisition opportunity in Italy at the end of 2025. In Italy, we will deliver 200,000 square meters of GLA in 2026, more than 10% of our annual target. And with a land bank of over 8 million square meters, we have a long runway for growth in Italy, a country with a significant undersupply of modern A-class industrial and logistics space. As our development pipeline is completed at over 10% yield on cost and revaluation gains are fully booked, we expect loan to value to move back towards our target range. To complete our development pipeline of 1.4 to 1.7 million square meters in 2026, we do not need additional equity capital due to our sector-leading yield on cost, around 10% from projects to be delivered in 2026. Every euro we invest in our pipeline increases our ICR and decreases our net debt to EBITDA as our leasing income comes on stream. This allows us to grow group rental income at double-digit rates while simultaneously improving the most important credit metrics. In 2025, we signed 1.7 billion euros of unsecured debt to fund our development business, debt refinancing, and our growth engine. We continue to demonstrate our ongoing strong market access whilst actively managing our funding costs. During the year, we renegotiated or repaid 1.6 billion euros of our most expensive bank loans. Looking through 2026 and beyond, CTP maintains a conservative debt maturity profile. We repaid 350 million euros of bonds maturing in January, and our only remaining bond maturity in 2026 is 275 million euros maturing at the end of September. Looking further ahead, maturities remain limited over 2027 and 2028, with less than 1 billion in total outstanding. Our liquidity at the end of 2025 stood at 2 billion euros, comprised of 700 million euros of cash and our 1.3 billion euro RCF, more than sufficient to meet our cash needs for the next 12 months. The average debt maturity stands at 4.8 years, and the weighted average cost of debt was 3.3%, which represents only a marginal increase compared to year-end 2024. We do not expect a material increase in our average cost of debt, as our marginal cost of funding is currently below 3.5% for the 5-year midterm period. Regarding the midterm outlook, a key message here is that the medium-term growth outlook for CTP remains unaltered. At our 2025 Capital Markets Day, we introduced our ambition to double the size of our portfolio to 30 million square meters. We expect to grow top-line income around 15% per annum, driven by rental growth in our operator business alongside double-digit organic GLA growth from our developer business as we build on our unrivaled land bank at 10% yield on cost. Supported by our growth engine as it seeks attractive global investment and growth opportunities. Digging deeper into those attractive return drivers. Firstly, we have the operator. Over 1,500 supportive tenants who pay on time, stay with us and grow with us. Secondly, we have our development business, led by the strategic land bank of more than 33 million square meters, either on balance sheet or under option, located mainly around our existing parks. This is the key component of our portfolio growth ambition. And thirdly, we have the growth engine, the global identifier of shareholder value accretive, land-led acquisition opportunities to continue to deliver high returns well above our cost of capital. We also continue to see above inflationary rental growth across our markets, supported by income reversion capture, positive nearshoring trend, production in Europe for Europe, and ongoing e-commerce growth driven by rising disposable incomes across our strong Central Eastern European region and our Western European markets. Previously, unlike the rest of the sector, we did not capitalize interest on development activities, which made comparability between companies for investors more difficult and made CTP appear more expensive on a simple earnings multiple basis. Going forward, we now capitalize interest to provide reporting harmonization with all other European real estate companies. Following this change, we now set our company-specific adjusted EPRA earnings per share guidance for 2026 at €1.01 to €1.03. This implies year-on-year growth of 9% at the lower end of the range, rising to 11% at the top end of the range when compared to the 2025 result. In summary, CTP delivers leading shareholder returns as a growth business with income and cash flow growth, development profit growth, and the growth engine lever through expanding our global exposure. Thank you for your attention. We now welcome your questions.